Good afternoon and welcome to our I Am a Founder webinar number 11. My name is Adam Brody. I'm the co-founder of Ignition Financial, and thank you very much for joining today. 2 months ago, we looked at investment and in seed and Series A companies and what was happening in the market and what might transpire over the coming months and quarters. So really looking at rounds there, 1 million up to about 3 million pounds. Today, we are going to focus on Series A, B, C, and D, so the much bigger early stage or venture rounds and also the growth capital rounds. And I'm delighted today that we are joined by Amit Hindocha, who is investment partner of Mobius Equity Partners, who specialise in Series A and Series B investment rounds, and also David Kellnar, who's head of growth capital solutions at Numis, who are very much focused on the growth raises, which are 50 to 100 million and above. David?
Correct.
Excellent. Amit, perhaps you could just say a few words about Mobius's focus and introduce yourself and give us a bit of background as to how your lockdown has been so far.
Thanks, Adam. Afternoon, everyone. So yeah, as Adam said, I'm an investor at Mobius, which is a £300 million VCT fund that is providing growth capital investments of between £2 to £20 million. So we typically write a check between the 2 to 5 million space to start off with. So it's the first institutional round that management teams are looking to raise, so Series A, and then we support the businesses typically for 2 to 3 funding rounds, so through Series B, C, and then by that point it's often outgrown our funding capabilities. Lockdown has been interesting. It has been probably a slightly slower quarter than we usually have. We've made a couple of follow-on investments into our portfolio for good reasons, businesses that have benefited from the macro environment, and we also announced our first new investment 2 weeks ago, which is good, but that's probably about half or a third of the volume of deals we'd usually be doing. So it's been pretty slow on the investment side, and we're obviously hoping that'll pick up as the lockdown eases over the next quarter or two.
Thank you, Amit. And David, I know you've got experience as an investor as well as an entrepreneur, and you've been producing some fantastic research and insights, particularly into the bigger growth tickets and investment sizes. But perhaps you could give us a bit of background as to what you do at Numis.
Sure, thanks, Adam. It's very kind. Very good to connect with you all this afternoon. Thank you. So, as Adam says, my name is David Kellnar. I'm one of the managing directors at Numis, the London-based investment bank, and I lead a team at Numis that we call Growth Capital Solutions team. And we're a team that works with kind of the most ambitious, high growth stage private companies globally, and we help them both with strategic advisory, and in particular around helping them raise capital. And that might be primaries, secondaries, M&A, strategic partnerships, and more. Some of the recent transactions that we've been involved with have been leading with the $450 million raise that Klarna did a few months ago. Also did $160 million secondary with TransferWise. And then the earlier stage, actually, we tend to focus a bit later, but occasionally we bend or break our own rules. We helped Get Here, which is a consumer delivery proposition. We introduced Mike Moritz, who ended up personally leading their Series A round. And in terms of our lockdown experience, I mean, I think Andy, firstly, just cognizant that a lot of people have had it sort of tougher than us personally, and just very mindful of that. I think in terms of the business dynamics that we've been seeing, it's been a particularly unusual time, obviously with COVID itself, but then we've seen a very significant change in the markets just in the last kind of 6 weeks or so, and I think we'll get to that shortly. But it's been quite a whipsaw of activity that we've seen. So interested in exploring some of that today.
Thank you very much. And I should say we want to encourage questions. We want this to be an interactive session. So if you do have any questions for David or Amit, please do put them in the Q&A box, and we'll come to them as quickly as we can. If you'd like to address them to Amit or David, so much the better. If not, we'll probably put them to both. We have a poll which Stu is going to put up. There we go. And it would be great if we could get some responses to the poll, and we'll flash up the answers, I think, as we get into the discussions. But while this is up, in case there are a few people who are perhaps unfamiliar with the terms Series A, B, C, and D, Amit, I'll put you on the spot. Perhaps you could start off by saying what differentiates perhaps a Series A from a Series B round, and then maybe David could add what the bigger bucks are for after that.
Yeah, okay. So Series A investments are broadly the first institutional investment that a business will take on. They start at, I think, around 2 million is the general data point, and go up to around about 5 million. So it's the first investment that you'll take on from a third party investor that is not an angel, family or friend or fool, if you're going down the traditional 3S route. And that is the point at which many VCTs like us first get involved. So we will write that check, and we will recognize that it's probably the start of a journey that means that within 18 to 24 months you'll be looking to raise a Series B round, which is probably your next round to be a materially bigger round. So if you took on a 2 to 3 Series A, you'd probably be looking for a 5 to 7 Series B. And it is the continuation of the scaling of the business and a recognition that the first tranche of capital has been put to good use, and that the shareholders and the management team collectively feel that taking on a bigger amount of capital can take you to the next 18 to 24 months, your journey, and into Series C and beyond. We occasionally participate in those Series C rounds, but by that point it is slightly outgrown our capacity. We can put up to 20 million in any single investment, and the rounds are starting to get to the point where we need to syndicate those out. So it's probably a good point at me to pass over for David to answer on what things look like at that scale.
Sure thing. So yeah, at the Series C stage and beyond, obviously the check sizes get a little bigger, so can be $50 to $100 million or more at the Series C and Series D. And really at that stage, it can be kind of broader axes of growth for the company. So there's typically significant further growth, obviously, in core products and territories. Often, these stages or beyond, companies are looking to become kind of leaders in their country or globally. And so there'll be extensive customer acquisition, but then also kind of additional axes of growth, whether it's adjacent territories, potentially complementary product lines, maybe capital for M&A and more. So it's really helping the company kind of stretch their legs and realize the scale of the opportunity that they've been preparing the foundations for up to that point.
Thank you, David. So Amit's your man if you want to conquer the UK and then go global with David and his team. We've got the poll results here. The first one this is quite interesting. It's confidence levels about fundraising. There's perhaps some cautious optimism, or perhaps some slight nervousness as well creeping in around a fundraising round, closing a fundraising round on what they would term as good terms in the next, I guess, 12 to 18 months. And of those attending, there is more than well, actually, the vast majority are going to need a funding round, an equity funding round in the next 18 months. So maybe we take from the mood there of the attendees, who are largely founders, and perhaps we could ask you both, maybe David, you could go first. What's the general sentiment within your firms and among investors in your network more than a quarter after we went into full lockdown?
Sure. Well, firstly, just to kind of contextualize, I guess, my comments in this discussion a bit, we're fortunate to have strong relationships with a lot of the leading growth investors globally. We're talking to them on a daily basis. So maybe I can give you a sense of some of the dynamics that we see. And it's been a very significant change, actually, just over the last few weeks. So if we go back to COVID, we saw a period of probably 2 to 3 months amidst COVID where there was a real pause. And I think clearly founders were having to take the time to fight fires and figure out how to deal with kind of an unprecedentedly challenging set of conditions.
Yeah.
And on the investor side, the proportion of time that was being spent on investors' portfolios, if you look at surveys that were done at the time, kind of doubled. So investors were really spending their time triaging their portfolio and making sure that the companies within them were getting the support that they needed. And clearly, attention and dry powder for significant new deals was pretty constrained. Since then, maybe I can just outline the change we saw, which is in the last, I'd say about 5 weeks, there's been a very marked change. And as the consequences of COVID have become a little clearer, and as we've had sustained buoyancy in public markets, which particularly growth stage tends to colour things, we've seen a real divergence. And the market's actually kind of bifurcated in the last few weeks, where on the investor side, at the growth stage, there is resurgent appetite for companies that are advantaged by or well aligned to the new normal. And for those companies, I think there's extensive appetite, there's high value. I think investors recognize that we've seen 2 years digitization in 2 months. This is, as Richard Watts at Merrion told us, this is the biggest channel shift in the history of the internet. Incumbents are weakened, and who's most advantaged by this? It's actually the digital disruptors. So I think investors recognize where the opportunity is. And I think with that, they see unique opportunity to kind of build positions in companies whose attention they maybe couldn't get before. But it is a divergent market, and clearly for impaired businesses, of which there are many right now, and a lot facing a lot of difficulty, the appetite is more limited, pricing is more challenging. After 2008, we crunched the numbers on this. You would have seen that valuations declined about 15 to 40%, took about 3 years to recover. And I think we're seeing that sort of bifurcation play through in the market at the moment. And just finally, on the founder side, we've seen a similar divergence where I think for founders whose businesses have been advantaged by COVID, after that initial firefighting period, I think they recognize that they're seeing reduced customer acquisition costs, impaired incumbents, more selective capital. For them, this is an opportunity to actually invest to strengthen their competitive advantage. And actually quite a few are now raising capital on a front-footed basis to do so. But again, the other side of that, unfortunately, there are many businesses that, of course, are struggling right now. And for a lot of them, the dynamics are very, very challenging. Founders are trying to manage those as best as they can. And I think for those founders, we're seeing a lot of what we call COVID convertibles, if you like, probably convertible notes, rounds just with insiders, deferring larger raises until next year. So after a big pause, a real divergence, I think, is what we've seen on both the investor and the founder side.
Okay. Amit, that I think that some of that sounds familiar to what you were touching on earlier. Particularly, I remember when we spoke in May, and we showed the charts of how investors were spending their time, and it was significant. There was a significant shift to the existing portfolio and away from new deals. Is that starting to balance out within Mobius at the moment?
Yeah, I think David gave a really interesting answer, and that's very reflective of what's happened in our business in the last month or so. So the portfolio, where we were very inward focused at the start of lockdown, is very much in a stable condition. There's been huge government measures that have helped support those businesses, and the good businesses have continued to. The good management teams, the good businesses have been able to trade through this period, and a number have emerged a lot stronger. 1 or 2 are still in difficult positions. We have a restaurant company in our portfolio. That is still playing itself out. But by and large, the portfolio has held up very well. Having been very inward focused, absolutely in the last month or so, we are now looking outward and saying it is time to be doing what a lot of what the day job is, which is making new investments. You have to remember that everyone has raised time-limited capital. This capital needs to be invested in a certain time period. That is the nature of how an investment firm works. Yep. So I think it's probably, if I was sat on the entrepreneur side of the table, to some extent, it's a great time to be raising funds. You're never going to get a quicker and more attentive audience from the investor side of the table, because they're not rushing around, they're not traveling, you have their full attention. The challenge around that, though, is the flip side of that is that there is an expectation from our side of the table that pricing is going to be a different conversation to the one we were having a few months ago, because the environment has uncertainties in it. So I think it's much easier to get people's attention now, but getting what you've termed, I think in the survey, a good deal, maybe depends on which side of the table you're sat at. But I'm pleased to see optimism on people wanting to raise money, because there is money out there that is looking to find good homes.
It's interesting point there you make about valuations. I think David mentioned after 2008, I think you said, was it 15 to 40% declines in valuations, David?
That's right, varying by stage, yes.
I remember 3 months ago when we had Amit and the two, and Jason and also Russell, the investors, on. I think the median feeling was about 20 to 25% declines, but equally there was still very much a feeling of, look, great companies are still going to be able to raise, and if they generate competitive tension, they're going to be able to close deals quickly and on good terms.
I think, Adam, if I may as well, there's just one point on that, which I thought was quite interesting when sort of crunched the numbers on this, which is when we think about valuations and moderations in those valuations, it's easy to forget context.
Yes.
If we look at what's happened to valuations over the last 5 years, median valuations have nearly tripled. So the median Series A valuation in 2013 was about $9 million, and in 2019 it was 23 million. Series B, it's gone from 27 to 68, and Series C, it's gone from 54 to 140.
Wow.
So we've seen, it's just helpful to be cognizant of the fact that there's been a huge run up in valuations in the last few years, and that we need to think about some of these moderations that are happening maybe in that context, and that we're coming off a place where you might argue they've been a little exuberant, you might argue that they haven't been, and that there's a good sort of debate to be had on that. But it's, moderation of sort of 15% on that is, maybe just puts that in context a little bit.
A small correction.
Well, yeah, and I think the other thing just to bear in mind is, and we're seeing the sharp end of this, that it really is very bifurcated, I think, in terms of pricing at the moment. The very strongest companies, I think, can still command a premium, and there still can be a kind of auction for those.
Yeah.
But I appreciate that, by definition, that is a very limited set of the market.
Okay. And while we're on valuations, it's something that's always fascinated me is there's a bit of an obsession in, certainly, if you look on LinkedIn and all of the PR around valuations, but it's almost, there's a bit of a devil in the detail, perhaps, in the terms for, how much is coming on as debt or convertibles, perhaps, what liquidation preferences are. David, you mentioned, and well, actually, Amit, you can comment on this, because I know all venture capital firms will pretty much insist on liquidation preferences, for example. But is there a changing balance there between valuation and other terms? So let me ask a kind of a direct question. If people have been pushing too hard on valuations in the past and valuations have gone up, have other terms such as liquidation preferences risen to kind of underwrite some of the risk as well?
Yeah, I mean, Adam, I think you're asking the leading question, because I think you and I worked on a deal a few years ago where you were, as you'll remember, the management team were intent on what I guess I consider to be an arbitrary, our business is worth £20 million, and come hell or high water, that's the only price we're going to transact at. Now, the headline price that we got to was the number they wanted, which was the 20 million. But in order to do that, we had to, I guess, do some clever structuring that meant that we could, as investors, still make a return at that level, if I was structuring that deal and there wasn't an arbitrary number that the management team were focused on saying we must have that as the headline pricing, you may have ended up with a different deal structure that didn't have some other protections for us. So when a line in the sand is drawn saying, look, this is the valuation and this is non-negotiable, then all an investor is looking to do is say, well, how can I make an appropriate return for my underlying investors, given the risk that is taken, and what other levers can I pull to make that come together? So I can see why entrepreneurs' management teams go there, but I think that it does often result in taking the deal into a certain direction, which may not necessarily be the most optimal direction. And that absolute focus on headline valuation can sometimes result in structures that perhaps aren't the appropriate structures for those teams and those businesses. But it's where people have become fixated in the last few years. And I'm not sure that is a positive feature, but unsurprisingly, as creative investors, we then look to find other ways that we can flex to make a deal happen.
David, is this I called it a valuation obsession? Is this more of an early stage matter versus the perhaps more mature approach in the later rounds?
I think, well, firstly, there's a slightly different context in later stage rounds, because you've got, perhaps explicitly, perhaps implicitly, one eye on the public market valuations, for which you are closer and somewhat working back from. And if you're engaging with leading so-called crossover firms, those are investors that can invest privately but then also invest publicly, and so can be very, very good long-term sort of partners for the journey. They will want to take a view on things and make sure that as they think about their returns and working backwards from public market valuations, there is a suitable path for them. So I think things do get a bit more sober, should we say? But it really varies. I think the point I'd sort of focus on is, I think valuation and that kind of discussion is, the question is, like most things in life, like, what are you optimizing for?
Yeah.
And I think what we see is that the best entrepreneurs, of course, are mindful of dilution and valuation, but ultimately they're optimizing for multiple things. One of those is dilution that is tolerable. They're also minded to get on board the kind of investors who can be really the right partners to help enable and drive the business to kind of global leadership in the years ahead. And so that will be very important to them. So there's more of a sense of partnership around that. Okay. And then also, the great entrepreneurs are optimizing not just for the current round, but frankly for the next one in advance, and thinking about how to create a set of circumstances where the progression through that time can continue to be positive, and where essentially they haven't legged themselves up too much by setting a bar that gives no room for maneuver, no room for error, such that the next round becomes very challenging. So the great entrepreneurs are usually optimizing on a kind of multi-axis basis for all of these things, and folks tend to meet somewhere that makes sense for everyone.
Okay, thank you for that. I think that probably has cleared up a lot in my mind as well, certainly. All right, so perhaps we can change tact a little bit here and focus on sectors, because David's already touched on it. Certainly, there are going to be some winners as well as inevitable strugglers. I think those seeking or looking at impairment, David referred to them as, 2008, post 2008, we saw the likes of Airbnb and Stripe and Square. Do you think this is going to provide some fertile ground for some businesses to really kind of push on with their growth going forward? David, perhaps we could hear from you first.
I think undoubtedly so. I think if you look at telemedicine, if you look at streaming, you look at online events, you look at payments, you look at last mile delivery and food, I think you're seeing albeit in not the circumstances any of us would have liked, but you're seeing the realization somewhat of of a digital dream that a lot of people have had for quite a long time that has been dramatically accelerated. And that impacts many sectors. And alongside that, you've had what you might call the rise of the home economy, where that impacts a lot of the consumption of those kind of areas, whether it's streaming and online events and more through to grocery and food and all the rest. So I think undoubtedly that there will be significant beneficiaries of that. I think what's really interesting is that it's obvious that digital adoption has accelerated. What might be slightly less obvious is how it's also been reshaped. Forgive me because I'm about to get the next numbers wrong, but they're directionally correct. There's a fascinating statistic I saw from Echo, the online prescription fulfillment service. And it showed that something like pre-COVID, about, and as I say, I apologise, these numbers won't be correct, but about 20% of its customer base was over 65. And within the course of 1 month, it was something like 40-50% of its customer base was over 65. And I think what that shows is that we are having whole segments of the population engaging digitally in ways that they hadn't before. And I think in many cases that will be a one-way journey. I think once you've had online grocery, once you've had telemedicine, once you've experienced maybe some online education, why would you go back? And I think a lot of that will be very sticky. So I think that's a profound change. Last couple of points I just make on this. One are that that was focused quite a lot on the consumer side, but we should recognise that this has also catalysed enormously both the opportunity for and the need around enterprise enablers. So whether it's cybersecurity, developer tools, authentication, certainly automation solutions like machine learning applications generally and robotic process automation and more, the infrastructure, if you like, the digital infrastructure to power the delivery of all of these services, combined with a significantly remote workforce, is giving these unprecedented opportunities and challenges around enterprise tooling. And so I think we're seeing a lot of activity and investment around that as well. And then the last thing I just know is, again, let's look at the context of all of this. Sadly, the high street is going to be changed forever with this. We've seen, very sad news over the last kind of 24, 48 hours with, unfortunately, I think what will be the first of many job cuts. And the high street, about 1 in 3 high street stores were loss-making pre-COVID. And so, we're challenged in terms of viability even before. Now, and I think a lot of those will sadly really struggle to reopen. And I think it's a much more challenging landscape for them. So it's not just that we've seen a huge increase in digital adoption and a reshaping of it. Bear in mind, it's often the incumbents, whether it's high street retailers or others, that are least well positioned to adapt to that new world, and therefore their likes will thin out as well. So there's an incredibly powerful set of changes there, as a result of which I think what we consume and how we consume it will be forever changed.
Amit, to a certain extent, do you think some of the changes or the winners or perhaps the winners and the losers that we're seeing are just an acceleration of trends which venture capitalists such as yourself have been predicting or investing in, really? I mean, one of your first investments was at Mobius was online education, My Tutor.
Yeah, you're good at this, Adam, because I was going to go there. I thought David answered the question really, really well. I thought I would give an example, and that was the one I thought would be most relevant. So
I'm storing your thunder, sorry.
One of the early deals I did at Mobius was into a business called My Tutor, which is an online tutoring platform. And Adam and the guys at Ignition assisted us on the due diligence of this transaction. And this business has scaled really well in the last 3 years, growing at sort of 100% year on year. But the biggest challenge it has had is converting what has always been an offline transaction. If you get a tutor for your kid, It is a former retired school teacher. It is someone who comes to your house. It's a 2 billion market, but it is so heavily an offline and traditional transaction. That's just the way it was done. And this business was trying to turn it into an online transaction, saying actually with modern technology, you can do the tutoring through your laptop, one-to-one tutoring. Someone doesn't need to waste the time coming to your living room. You can do it just as well using a virtual classroom. And this business has scaled really well, but there was always that friction of the buyer, who are typically parents, saying, well, no, we know and recognize this as offline. That's gone out of the window in the last 3 months because that has just not been possible. And so online tutoring has now become not just acceptable, but government endorsed. So the government is currently in consultation around discussions around putting several £100 million of state money behind online tutoring to provide over the summer to help disadvantaged children who've missed out on schooling. So not only has there been a customer acceptance and adoption because there was nowhere else to go, and actually digitally delivering this is the right way to do it, it's now actually getting a huge stamp of approval from central government. So that business, if things pan out well, may have accelerated 4 years forward in its growth plans just because of a fundamental shift in how people view tutoring as a result of what's happened in COVID. So the smart investor would have foreseen that 3 or 4 years ago, and obviously put some money into this business. But it is luck, I guess, that has accelerated these things. But it was a direction of travel that we had picked up on, but we did need something to happen to sort of cause that adoption to accelerate. And this is the macro incident that has done that.
Okay, thank you. So I think leading on from the sectors, one of the things which struck me is that during lockdown, all of the things that we've turned to, David's mentioned a few of them, but tools around streaming, the changing nature of work, they all seem to come from the Valley, or the US, I should say. Slack, Zoom, Netflix, you could go on and on and on. Is there going to be a growing divide, or is there already a growing divide, do you think, between Europe and the US, or perhaps specifically the UK? I mean, are we going to fall behind as a country for rapidly scaling businesses? David, perhaps we could ask you first.
No, I definitely challenge that. I think that was the case a decade ago. I think there's been the most incredible and exciting change in the European ecosystem over the last few years. And as a result, there's a growing number of phenomenal companies in the UK and Europe that are becoming mainstay parts of all of our lives across multiple sectors. I mean, I guess just to try and put some numbers around that, and in particular the UK's place within that. I mean, the UK has about 53% of investment in terms of startups across Europe overall. It's got about 60% of Europe's unicorns, and Europe more broadly, certainly not just the UK. We've seen thriving hubs in Germany, France, Sweden, frankly, all across Europe. So, and as I look at the kind of growth stage companies that we serve, you need to look at sort of Klarna or others. That's a $5.5 billion company, the last raise, and the Spotify we saw over the last few days just hit 50 billion in market cap. So no, I think that would have been the case 10 years ago, but I think Europe and the European ecosystem have come of age.
Okay. Amit, perhaps what do you see in terms of the do you agree with David? Is the geographic gap of 10 years ago narrowing? Are you seeing, particularly, I guess, with a focus on the UK?
Yeah, I readily concur with what Dave said. That some of this is down to there's two sides to this. Is there the entrepreneurial drive and spirit in the UK that people are coming up with new businesses, new ideas, trying to disrupt industries? Yes, absolutely. And then the other side of that equation is, do we have sufficient capital to provide those businesses with the money and support that they need? We absolutely do. There is a wall of money in the UK looking to back good businesses. Yeah. So if you put those two things together, then I don't see us being at any disadvantage at all. So yeah, the impact of COVID on various economies, only time will tell. But the fundamentals of, do we have ambitious entrepreneurial people looking to build businesses, that remains there, and do we have the capital to support them? Absolutely. So those building blocks remain in place, and that gives me a lot of confidence.
An additional question: do you think investors will be looking for more resilience into and more resilience and more flexibility in the companies and the management team as a result of COVID and what's happened at the moment?
Yeah, flexibility is an interesting word. I think what we've seen during this period is that the teams that we had backed, that we considered to be agile, high quality, and where there were gaps, we had worked to fill those. They were really well positioned to evolve, to adapt, to move, and to reposition their businesses. So the fundamental investment decision in the early stage comes to, do we think this is a good concept, and have we got the right people to deliver that, and can we add to them? That remains the same. So I mentioned earlier that we have an investment in a restaurant chain. That business has faced unbelievable headwinds in the last quarter. We have a good team there, and the way they've reacted to that, their plans for taking the business forward. It isn't a sector you would readily choose to jump into at the moment, but I remain confident because we have a good team and a clear strategy and a vision, and they have reacted very well to these challenges in being fleet of foot and repositioning their business. So investors were always looking for that in their management teams, and what this crisis has shown is that those that have been able to execute and be flexible, as you call it, are even more well placed to benefit from the recovery going forward. So I don't think it's changed. I think we were always seeking that from teams.
And David, I read in your one of your research publications a quote: "Speed and independence separate the best founders from the rest." Is that something that you would concur with?
Yeah, so it was Harry from Excel who said that to us, and so I think it's dead right. And I think what's interesting though is that COVID has provided an additional axis along which investors can evaluate founding teams. And obviously the point is not kind of avoiding difficulty, that this is an externality that none had envisaged, but investors can be looking and will look, I think, for the speed and quality of decision making around COVID that founders would have made as part of their decision making. So, I'd certainly recommend to founders who are listening to this that it's worth, hopefully they're able to respond okay to the challenges at the time, but it's also just worth thinking about how they can most strongly position that to future investors to show that it's a mark of their quality as leaders about how they responded to an unprecedented and very, very challenging situation.
Yeah, I think that's very, very good advice actually for the founders that are listening here. We'll do one more question, then we'll go to we've had some questions in from attendees. If there are any more questions, please do put them in the Q&A box. Perhaps we could ask you both what your predictions are for investment levels, I suppose, in Q3, Q4. Amit, Series A, Series B?
Yeah, I think Q3 is likely to, unfortunately, be a little bit sluggish on the basis that the transactions typically take 8 to 12 weeks. And so if you're not currently working on something or it's not identified, it's probably not going to close in Q3. And certainly from a lot of the investors I know in the market, things are starting to pick up, but not with enough. They're not advanced enough to necessarily result in a buzzing Q3. I am much more optimistic about Q4 and into 2021, because I think that a number of the advisors we speak to are starting to get mandated on a number of transactions. Those will complete in Q4, and I expect some of the the lost quarter of the last quarter and the slow quarter of the coming quarter to be caught up in next year. So optimistic in the medium term, but I think we've got a bit of a way to go in the short term.
And David, same question, but for Series C, Series D, will it follow that trend, or do you think it'll be something slightly different?
So I think this divergence that we've seen is and will continue. I think the appetite from investors for tier one companies, as I say, has really come back with a vengeance. And I was talking with an investor yesterday who said, let me get this right, that COVID advantage companies are sort of tripping after themselves to get out to market fast enough. I think that's, for those that are advantaged, I think clearly things will remain more challenging to get the attention of investors for companies that are having a less kind of rosy set of circumstances. I also think for all it is just worth noting that the pragmatics and practicalities around deal processes can be more challenging. They can be elongated, talk sort of virtual site visits as opposed to practical. And so, I think everyone is recognizing that. So I think, overall, I guess my message would be that, especially for as long as public markets remain as buoyant as they have been, I think there is actually a lot of activity that's come back in the growth stage markets. But I do think it's more concentrated and folks making fewer, more selective, high conviction bets.
I think your point on the pragmatism and practicality of getting deal done is very interesting. 3 months ago, I remember the investors on the webinar were saying, look, it's difficult for us to invest in a team where we haven't met them face to face. And I guess that's even harder, David, at the level that you're talking about, because you're talking about international investors, global businesses. Plane and air travel is quite challenging at the moment. Although I guess if there's £100 million investment on the table, people are going to get on the plane almost regardless, as much as they need to.
No, I think, the practicalities of these deals are definitely, challenged at the moment. Yeah. But I think, again, if you look at the constituents of those conversations in terms of founders and investors and others, these are all pretty digitally native people who are, investing again in the sort of digital future that they're all embracing. So, they're not averse to spending plenty of time on Zoom and getting to know each other. And I think they're also pretty creative about ways to work around that. As I say, that there's a company that we're supporting at the moment that developed a virtual site visit to help take people behind the scenes and get a feel for, the mechanics at the company. When we speak to investors, they're sometimes doing some more extensive kind of reference and background checking to help, getting confidence in the absence of meeting in person. So it's definitely tougher than it was, but also folks are being quite creative about, ways to try and work around that.
Thank you. I'm conscious of the time, so I think we'll do 2 questions and then we'll wrap up. First question, I think this was probably best for Amit. It's from Patrick. From a founder's point of view, does a convertible loan note make more sense for an interim post-seed round now to bridge to a Series A round in 18 months' time?
Look, it's a very logical route to go down. I think investors are very open to doing convertible loan notes, and it effectively puts you on the radar of the investor that you choose to partner with. Effectively, you're in bed with them to some extent, and I think that subject to performance being broadly where you and they expect it to be, I'd be very surprised if they weren't in a situation where they then converted and followed their money. So I think you take some of the pain away of doing, if you take the interim seed round, you're really postponing the decision and the challenges of doing an institutional round. If you do the convertible loan note round, you've probably absorbed quite a lot of that and got yourself well positioned with that investor. So we're seeing a lot of people looking to do that. It's certainly something we are doing ourselves. So yeah, I think it's a very good route for people to consider at the moment. Thanks,
Amit. And I think final question, Dave, maybe we could ask you, we've had a question about, are there any specific sectors which you think the UK could take the lead on or is taking the lead on?
It's an interesting question. I think, I mean, in terms of rather than a sectoral basis, kind of enabling basis, I mean, again, I just come back to the UK's strength around machine learning and AI related technologies. And given that that's a pretty key enabling technology across every sector, you know, I think you're seeing a range of leading companies that are establishing globally significant companies in that space and enabling others around that. So I think that's what I think about. But otherwise, you know, whether it's telemedicine, we've got some leading companies here, whether it's online events, we've got some interesting earlier stage companies there, and around a lot of enterprise enablers as well. There's a huge number. So I'm not being very specific because I think honestly there's a lot to play for in a number of sectors. I think whether it's media as well, you know, Europe's got a very strong base for media. So I think honestly it's all to play for in terms of globally significant companies in most sectors, actually, from Europe and including the UK.
I think that's a fair response. You said it earlier, is it 50 to 60% of European investment is happening in the UK? So we must be leading on a number of fronts, certainly within Europe, but also globally. Okay, I think we'll call it there. Thank you everyone for joining us and for tuning in, and especially thank you to Amit and to David. We will follow up in the usual way, letting you know how to get in touch with both of our panelists, and we'll also share some of David's excellent research. Is well worth a read if you get the chance. Thank you very much, and have a good weekend when it arrives.